Hi, I'm Raisa Lebron, and I will be presenting on Countrywide Financial and their role on the subprime mortgage crisis. I'm going to start by giving a little bit of background about the company, the CEO, and basically the events that led to the eventual demise of Countrywide Financial, as well as the events that led to the actual crisis in 2007, 2008. So Countrywide Financial was founded in 1969, extremely successful company from the beginning. They hoped to be a large mortgage lender, which they ended up becoming the number one home lender in the United States with a big concentration in California. They provided mortgage origination services, as well as loan servicing, home equity loans, and other services as well. And they were a big time player in secondary markets such as mortgage-backed securities. Angelo Mozillo was one of the co-founders, and he essentially became the face of the company when he ascended to CEO in the early 2000s. At that time, Countrywide Financial was the third largest lender in the US, with Wells Fargo being number one. So within a year of him basically ascending to this position, he surpassed Wells Fargo, making Countrywide Financial the number one home lender in the US, gaining about a 17% market share. In about 2003, Fortune magazine published an article called Meet the 23,000% Stock, stating that they had the best stock performance of any financial services company within the S&P 500. So needless to say, they had tremendous growth over the years, also in a very short period of time. And, it was very remarkable seeing the results. By 2007, they had $408 billion in mortgage originations and a servicing portfolio of about 1.5 trillion with 9 million loans. So again, a lot of growth, a lot of money they were handling, a lot of people they were lending to. So I want to kind of discuss the state of the market at the time and kind of what led up to that point that they, had so much growth in 2003 through 2007. What conditions were existing at that time that allowed for this to happen. So in 2000, 2001, there was, economic decline due to the horrific events of 9/11. So in order to spur economic activity, the Federal Reserve decided to lower the rates continuously about 17 times from 6.75% to extremely low rate of 1.75%. This definitely spurred a lot of growth, with that impacting the housing market, which had tremendous boom. So this, just provided the opportunity for people to have more access to capital, for people to be able to finally start that business or buy that home or buy that car, because they now were able to access money more easily. At the time, also the government, when it comes to the housing, they had an initiative to increase minority homeowners. They were providing tax credits and other incentives. They noticed that there were certain practices of discrimination when it came to certain people in certain economic situations where they were not allowed or given the same opportunities as others to have a piece of the American dream that American had. So the American Dream Act was top of the agenda for the administration at the time. So there was a lot of speculation of a growing market. It was at an all-time high. The SEC suspended the net capital rule for five of the major banks, which meant that these banks were now able to have higher leverage because they weren't required to keep a certain minimum reserve that they were required to have before this. So as you can see, a lot of economic activity, a lot happening, a lot of growth from both ends. The banks are lending money. Regular consumers are itching to go out there and spend money and make investments because they have access to 1.75% interest rates, which it's pretty great. So I just now want to kind of discuss how this translated into, some of the practices that certain business adopted as a result of seeing so much economic activity, especially in the home market. So what happened was that a lot of banks started getting involved in subprime loans. So essentially what this means is you have a borrower with low credit rating, possibly, a credit risk borrower that, let's say, has a bad credit score, probably doesn't have any assets, any liquid assets. They would be approved for a loan for a home, but at a higher rate than what was currently going in the market. So, for example, let's say you've been wanting to own a home forever, and you have a job that doesn't pay you an exorbitant amount of money, but you've been saving little by little. You have something in your bank account. Your credit score is pretty low. You're not that economic savvy, etc. So you see that there's so many homes now in the market, and you get excited. You're like, oh, this is the time. It's all over the news of what's happening. So you go into this bank and you're like, Countrywide Financial, I want to buy this home for $500,000. Please approve me. What they would say is, in their underwriting process, they'll look at the borrower and say, okay, well, you have a terrible credit score. You probably don't have these assets. We are going to approve you for that $500,000 loan, but you're going to pay us, let's say, 3% interest rate when, let's say, a good credit borrower is paying 1.75%, right? So that's a huge difference. So the predatory lend, there's nothing wrong with with giving a subprime, right? Because as a lender, you're protecting yourself because you're taking on so much credit risk. What ended up happening is that these banks got greedy and started basically taking advantage of people that didn't know better, and basically prying on that dream that they had to own a piece of the American dream. So basically they were saying, okay, if you don't have a job, if you don't have any income, you don't have any assets, it's fine, we'll approve you. In 2007, it showed that 40% of the loans that were approved by Countrywide Financial were automated approvals, which means that no one really stopped and took a look to dissect the information and ensure that these borrowers were qualified or were able to actually repay these high loans that they were being given. Also, another predatory practice that they implemented was in their underwriting process, in either approving or denying someone for credit. What they decided to do was, if the person had cash reserves, which would essentially say you have some assets that if you go into default, we can basically take that, or you can use that, to kind of help you and offset the risks that you're taking on. So that would basically exclude these cash reserves from the underwriting, which would, essentially put these people at a worse interest rate than they would have otherwise gotten if they would have taken the cash reserve into account. So, all of this was basically done because the secondary markets were at a boom. Again, late 90s, early 2000s, this was the hot asset. This is like the thing to do. So basically, when banks or companies like Countrywide Financial issued these, loans to these borrowers, they would basically package it, sell it on secondary markets. A lot of banks would come buy these loans and make money off of it. And Countrywide Financial obviously was making money too because of the higher interest rates that they were charging, these people. So they also had an aggressive sales incentive structure. They had extremely high commissions for their sales team, which was based on essentially selling as many loans as possible that could be sold in those secondary markets. So anything that I could go and spin off and sell to Fannie and Freddie, great, give it to me. So they were basically purchasing, I think, about 70% of all the subprime loans at the time. They were also rewarded for bundles, which means that if you have a borrower come in for that mortgage and you're like, okay, I'm going to approve you for $500,000, already they're being approved for probably an amount that they are most likely not able to pay off. It's way above their limits. But they would also, talk them into opening a home equity line, which is even more debt for these people. So again, predatory lending, but also the sales team being incentivized to do this and being paid extremely well to do so. One of the questions that arises is, well, where was the regulation in all of this? Well, you're seeing so much growth. A lot of this is run by the people down on Wall Street. They're interested in seeing returns. They're interested in seeing money in their pockets. A lot of people at the top are being paid extremely well. Angela Mozillo, the CEO of Countrywide Financial, made so much money, during this time period. A lot of people did. So what ends up happening is you have people lobbying against any type of reform or any type of tightening that would basically put limits on what you're doing and ultimately what you can earn, right? So that was going on. Just kind of want to give a timeline of how that basically downfolded. So again, 2000 to 2004, this is when the market was booming, everyone was buying, people were borrowing, etc. In 2005, however, the Federal Reserve decided to increase interest rates again to kind of combat some of the inflation that was going on at the time. So what ended up happening, kind of the inverse that happened in 2001 when they lowered those rates to such a low amount, such a low percentage. So growth started to halt, which means some people started to lose their jobs. Home prices began to decline. Some people started to default on those loans. If you don't have a job to pay for your expenses, you're probably not going to have money to repay, the loans at these high interest rates. So by 2006, a lot of banks, started filing for bankruptcy or just shutting down because they couldn't handle all of the negative that came from all of the defaults from all of those loans that they had underwritten. So by 2007, they continued to default. Countrywide Financial's CEO Mozilla continually, spoke publicly and continued to say that their company was doing well, kind of not wanting to own up to the fact that they were in hot water. Needless to say, the guy, owned a lot of shares back in the day when they first went public, but he did not buy any new shares since late 90s. And in fact, throughout the entire period that this was going on, even though they were having astronomical growth, he was selling off some of his shares of the company. So that should have been an indication to some people that something was going wrong, but no one wants to really, get the magnifying glass and go look at what's going on because everyone is more interested in, well, I'm getting my money to buy my house. I don't care. And they're making their money because, everything is great. So again, a lot of people were panicking. So they announced that they were putting $388 million aside to cover risks related to these non-performing loans. So a lot of customers, were lined up at their offices, wanting to withdraw their funds, making sure that their money wasn't the one that was going to be tied up, basically when this is all tanking. Again, just them trying to show face and continue to act like business is going well as usual. They drew down $11.5 billion from its line of credit from 40 different banks. They also sold a 60% stake of their company to Bank of America, which raised an additional $2 billion. Things just continued to spiral down. More people were losing their jobs. More people were going into default. So I just want to share quotes of that time. So this was in August 2007. As of June 30th, almost 1 in 4 subprime loans that Countrywide services was delinquent, up from 15% in the same period last year, according to company filings. Almost 10% were delinquent by 90 days or more, compared with last year's rate of 5.35%. So just to give you a little picture of how bad things were. And just a side note, so they would also lend money to people that were 90 days late or more on previous debts, which is ridiculous. So again, a lot of jobs were eliminated within Countrywide Financial. They finally, at the end of 2007, decided to stop their subprime lending business. And for the first time in 25 years, they reported a first quarter loss of $1.2 billion. By 2008, there were a lot of bankruptcy rumors of the company. Their stock just kept plummeting. At one point, it was trading, in the high 40s. By this time, it ended up at $5.47 per share. Bank of America, probably seeing an opportunity, decided to purchase Countrywide Financial. Originally, it was for about $4 billion, a little higher, but it ended up selling for about $2.8 billion in stock. And then, to their demise as well, because one, Mozilla ended up being charged by the SEC on securities fraud, found guilty as well of misrepresenting financials and a slew of other things. So needless to say, there were so many lawsuits coming out of the woodworks because obviously so many people were hurt by all of this, right? There were 3.1 million foreclosures on 2.3 million homes, which was an increase of 81% from 2007. So Bank of America, by purchasing Countrywide Financial, again, they probably saw an opportunity to take them over. Not sure what the thought process was in purchasing them at such a terrible time. But they ended up losing billions of dollars just settling and trying to crawl their way out of this mess that Countrywide Financial left. So just wanted to show a little bit of a foreclosure cycle. So just really quickly, housing prices decline, which is what was going on when 2005 when the rates started to go up and people started to default. They had negative equity in their homes. So these homeowners end up walking away or, doing involuntary foreclosures, which again increases the supplies of home because they don't own them anymore. It goes back to the bank, right? So when they have these foreclosures, the mortgage payments decline. Obviously, they're not paying, which decreases the value of the mortgage-backed securities, which again, the banks are heavily invested in because this was their bread and butter. So they start having losses. They stop lending. Economic activity continues to slow down. There's more unemployment, and it just becomes this vicious, terrible cycle that really is really bad more for those poor borrowers that thought they were getting a piece of this American dream and doing something great for themselves and their family, but not really understanding what it was really costing them. So what are some of the lessons learned and some of the aftermath basically of this terrible crisis? So in response to this, the government started taking action to address and prevent such events from taking place again. There were a series of regulations proposed to ensure more consumer protection and transparency, ensuring executive compensation was looked into. Again, Angelo Mozilo of Countrywide Financial, alongside many other, head executives, made an extreme amount of money during this time period. Even though he was found guilty on securities fraud and all of these other things, he still made out very well. I mean, to this day, the guy has a net worth of $600 million, I think it is. So again, the people that really suffered were those poor borrowers that basically lost everything as a result of these people basically wanting to make money preying on the weak. So, the Dodd-Frank Act was signed in 2010. There were also more regulations for people that wanted to do loan originations, like, they probably need to do more classes or take exams, etc., something like that, just so that they can be, more aware of what's going on, and have the necessary credentials in order to, be able to service people better and hopefully prevent this from happening in the future. So in lessons and key takeaways for risk managers, I think one of the things that I learned just by going through this case was that greed will always catch up to you. I think this was essentially a case of a lot of greed, and people not knowing when to stop and when to pull out. Again, to the last second, the CEO of this company just refused to accept the fact, or at least publicly, let people know, yes, we are basically going down, and we're doing our best to make it right for people. It was always like, no, nothing's going on, we're fine, we're going to come out of this, we're going to survive this. They were lucky that they were bought out by Bank of America. A lot of people didn't have the same luck. Nothing lasts forever. Again, no one to call it quits. And for risk managers, I think it's really important for them to be independent, and no one to step in. And again, I think it all ties in with greed. But I think, risk managers, this is your job. Your job is to look at the data that you have in front of you, look at the decisions that are being made, and make those projections and see, okay, we see what we're doing, and it's not right. And just being able to step in and say something, raise your hand, if they continue to, like the people at the top, the CEO, etc. I mean, they do have the power at the end of the day, but you need to be independent, and you need to be able to say, no, this is not right. And also be able to look at the financials and look at, the business plan and say, guys, this is not going to work. This is not sustainable. I mean, someone should have been smart enough to know that at some point this could have tilted the other way, right? So again, people wanted to make money, make a quick buck on the back of other people, hardworking people. And at the end of the day, really, they were the ones that really lost out on this. And hopefully they've learned their lesson. I mean, a lot of banks were obviously bailed out, but hopefully these new legislations that are put into place are for the better, and really end up helping people in the future so that this doesn't happen again. And just some sources that I use to get my information. And that's it. Thank you so much.